Level 1. Beginner Investor. You open an investment account for the first time. The screen looks simple. Buy, sell, green numbers, red numbers. But nothing about it feels simple when the money is yours. You deposit your first $500. Not enough to retire. Not enough to change your life. But enough that losing $50 would annoy you for the rest of the week. You start scrolling. Apple, Amazon, Microsoft, companies you recognize. And this is the first mental shift. You are not buying a number moving on a screen. When you buy stock, you are buying an ownership interest in a business. So instead of asking, is this stock going up tomorrow? You begin asking, what does this company actually do? How does it make money? Why will customers still pay it 5 years from now? That question separates investing from gambling on price movements. At this level, your returns almost do not matter. If your $500 goes up 10%, congratulations, you made $50. That is not changing your life. The valuable thing you are building is understanding. You learn that markets fall. You learn that businesses fail. You learn that no investment return is guaranteed. And you realize the first level of investing is not about making money. It is about learning how not to panic when money starts moving. Once you understand that, you move to level 2. Level 2, the consistent investor. Now you invest every month. Maybe $200, maybe $500, maybe $1,000. Whatever your actual budget can support. The important part is that you stop waiting for the perfect day. You automate the contribution. The market goes up, money goes in. The market goes down, money still goes in. That approach is called dollar cost averaging, investing equal amounts at regular intervals regardless of market movements. It can create consistency, although it does not guarantee profits or protect you from losses. Your portfolio begins taking shape. Maybe broad index funds, maybe ETFs, maybe some individual companies you have actually researched. And now you learn another word, diversification. It does not mean owning 10 technology stocks instead of one. It means spreading money across investments so one bad position does not control your entire financial future. The SEC describes diversification as spreading money among investments to reduce risk, while noting that your appropriate allocation depends on your time horizon and your willingness and ability to take risk. Then the market drops 12%. Your account drops with it. This is your first real test. You learn something important. Volatility is risk, but it is not the only risk. There is also concentration risk, liquidity risk, business risk, and the risk that your own emotions make you abandon a long-term plan at the worst possible moment. So you stop checking the account every hour. You continue contributing. You start thinking in years instead of Fridays. And slowly, you stop behaving like somebody who owns investments. You start behaving like an investor. Level 3, the $100,000 investor. Then one day, the portfolio crosses $100,000. This number changes the way market movements feel. A 1% move is now $1,000. A 10% move is $10,000. For the first time, your portfolio can move by an amount larger than what you contribute in an entire month. This is where compounding stops feeling theoretical. You are still adding money, but now the capital itself has enough weight to matter. And your strategy becomes more organized. You decide how much exposure you actually want to stocks, bonds, cash, and other investments based on your goals and risk tolerance. Then you rebalance when your holdings drift too far away from that plan. Rebalancing simply means bringing your portfolio back toward its intended allocation after some investments have grown faster than others. The SEC notes that investors may rebalance by selling overweight positions, adding to underweight positions, or directing new contributions toward them. But there is another financial problem that becomes impossible to ignore at this level. Your investments may be growing while your debt is draining money in the background. Maybe you have $50,000 invested and still carry credit card balances at extremely high interest rates. Maybe your credit report contains legitimate errors you never bothered to correct. Maybe you keep applying for new debt every few months. Building assets while ignoring the rest of your financial structure can become like filling a bucket with a hole in the bottom. So you clean up the foundation too. Pay down expensive revolving debt. Protect every payment. Review all 3 credit reports. Correct genuine inaccuracies. Stop chasing approvals you do not need. Because investing is about building assets. Strong credit and controlled debt are about protecting the cash flow that lets you keep building them. Level 4. The advanced investor now, your portfolio reaches somewhere around $250,000. Then $500,000. Eventually maybe $1 million. And something changes. A small percentage difference suddenly represents serious money. 2% on $500,000, $10,000. 2% on $1 million is $20,000. So you stop obsessing over finding the next hot stock. You start obsessing over structure, fees, taxes, risk, liquidity, diversification, time horizon. You begin asking, what happens to this portfolio if stocks fall 30%? What if I need cash during that decline? How much of my wealth is tied to one company? How much risk am I taking to earn this return? This is where sophistication starts looking less exciting. The beginner thinks advanced investing means making more predictions. The advanced investor often spends more time preparing for predictions being wrong. You might add bonds, real estate exposure, more cash reserves, different types of investments, not because complexity itself is impressive. Because assets that behave differently can reduce dependence on one outcome. The SEC specifically notes that asset allocation should reflect both time horizon and risk tolerance, and that diversification can reduce but never eliminate the chance of significant losses. At level 4, the question changes from how much can I make to how much damage can I survive. Level 5, the high net worth investor, then your net worth or investment assets cross 7 figures. And suddenly you start hearing a new vocabulary. Private equity, private credit, venture capital, private real estate funds, direct deals. But here is where social media gets this level wrong. Having $1 million does not automatically unlock every private investment in America. Under current SEC rules, one way an individual can qualify as an accredited investor is having net worth above $1 million excluding the primary residence. Other paths include income above $200,000 individually or $300,000 with a spouse or partner for each of the prior 2 years with a reasonable expectation of the same current year income, plus certain professional credential routes. Accredited does not mean expert, it does not mean safe, and it definitely does not mean every private deal is good. Private equity can require capital to remain locked up for years, and the SEC warns that these investments are often illiquid and can restrict investors from withdrawing money. That creates the real challenge at level 5. At lower levels, you struggle to find opportunities. Now opportunities begin finding you. The skill becomes saying no. Someone has a real estate deal. Someone is raising a fund. Someone has a startup. Someone knows somebody who supposedly has a guaranteed opportunity. You stop being impressed that you were invited. You start reading the terms. Who controls the money? What are the fees? When can I exit? What happens if the investment performs badly? What does the manager get paid even if I lose? At this level, access is not the advantage. Selection is. Level 6, the professional scale investor now. Imagine the portfolio reaches $10 million, then $25 million, then $50 million. A 5% move on $10 million is $500,000. On $50 million, it is $2.5 million. Percentages have become businesses, houses, entire salaries. Your investment process becomes more formal. Maybe you work with an investment advisor, tax professionals, attorneys, estate planning professionals. Maybe an investment entity or family office style structure makes sense. Not every wealthy investor needs the same setup. The point is that the financial life has become too large for random decisions. You track performance against benchmarks. You track liquidity. You think about how much capital is committed for years. You think about what happens if several investments fail at once. And protecting capital becomes more important. Because losing 50% requires a 100% gain just to get back to where you started. You finally understand why experienced investors can appear boring. They are not trying to win every trade. They are trying to stay in the game. Level 7, the institutional investor at Level 7. This is no longer only personal wealth. You may be managing hundreds of millions or billions through a pension, endowment, fund, insurance company, family office, or another institutional structure. Now you cannot treat a $200 million portfolio like somebody managing $20,000 on an app. You are allocating capital. How much goes to public equities, fixed income, private markets, real estate, credit, cash? You may invest through outside managers rather than selecting every security directly. Now due diligence becomes an operation. Teams review managers, legal documents, fees, liquidity, risk, concentration, performance. A decision might commit $25 million for 7 years. You cannot simply change your mind Tuesday morning and press sell. That is why liquidity becomes strategic. At this scale, the best investment is not always the one with the highest projected return. It may be the investment that fits the entire portfolio. You are no longer asking, is this a good asset? You are asking, what job does this asset perform inside everything else we own? Level 8. The billionaire investor. Then the scale becomes almost difficult to understand. Net worth crosses $1 billion. A 1% change represents $10 million. But billionaire investing does not simply mean buying bigger versions of the same stocks. Much of the wealth may be concentrated in businesses the investor founded, controls, or owns significant stakes in. Investments can involve acquisitions, direct stakes, private companies, co-investments, entire operating businesses, and liquidity becomes complicated. If you own an enormous stake in one company, you cannot necessarily press one button and sell the entire position without affecting the price, creating disclosure issues, or changing how the market interprets the sale. Large transactions require planning. At this level, capital can create influence. A large investment can help finance a company. An acquisition can change an industry. A major disclosed position can attract attention from other investors. But this is also the level where one lesson from level 1 becomes more important than ever. You can still be wrong. $1 billion does not repeal risk. Money increases your ability to survive mistakes. It does not make mistakes impossible. And that is the strange thing about all 8 levels. The numbers change, the rooms change, the opportunities change, but the basic game never completely changes. Level 1 teaches ownership. Level 2 teaches consistency. Level 3 teaches compounding. Level 4 teaches risk management. Level 5 teaches selection. Level 6 teaches capital preservation. Level 7 teaches allocation. Level 8 teaches scale. At the beginning, you were asking, what should I buy? Eventually, the better question becomes, what am I trying to accomplish with this capital? What can go wrong, and can I survive if it does? That is the evolution of an investor, not from 500 to $1 billion, from reacting to thinking, from chasing returns to managing risk, from buying investments to building systems. And whatever level you are at right now, the next level does not begin when your account hits some magical number. It begins when your decisions become strong enough to handle the amount of money you want to have. Because getting more capital is only half the game. Knowing what to do when you finally have it is the part that determines whether you keep it.